So in business control, we need to have this in mind. One party takes over another company, and in the event of taking over the business, there are critical elements that we need to actually focus our concentration in. To determine if a business combination has happened, an acquirer must first evaluate whether it has acquired business or a group of assets. The distinction is critical because the accounting treatment is very different based on the determination. So when actually you look at business combination, it's about the acquisition of a business. And the only way you can be able to establish whether the business has been acquired is the acquirement of business or group of assets in a business. Now we look at the accounting perspective in the business acquisition. It is accounted for using the acquisition method of accounting. The following transactions are often associated with the business combination but are explicitly excluded from the scope of the acquisition method. Transaction between entities under common control. So these are transactions which are excluded in the event of doing business combination. The creation of joint ventures. So you can actually join a venture. So the two businesses which are combining their effort can actually join their ventures. Acquisition by not-for-profit entities occurring before December 15, 2009. So any transaction which has been done as far as non-for-profit entities or other books talk about non-profit making organization, and then measures of non-profit, non-for, not-for-profit making entities. So measures means bringing together businesses with an aim to actually capitalize on the market. Then we have transaction between not-for-profit business that do not acquire the consolidation of one not for. So we are looking at the event whereby not for profit entities is not supposed to have a consolidation with another not for profit making entities. So two non-profit organizations cannot combine their efforts and form a business combination. Now, the consolidation of variable interest entities, that is collateralist financing entities. So there are variables which are actually supposed to be brought together in the event of combination. Now, this is very important now. We look at the steps which are normally followed in business combination. So these are the critical steps which are normally followed in business combination. Number one, step number one, what you need to do is actually determine the acquirer. Who is acquiring what? So number one is to establish what is to be acquired and who is acquiring what. Number two step, determine the acquisition date. You must know when is the acquisition is supposed to be undertaken. Then step number three, recognize and measure the assets. So it is now upon you to actually establish the value of assets in a particular business. And then finally, recognize and measure any goodwill. Again, it is upon the business to establish. In time of combination, we need to have this into perspective that you need to recognize and measure the goodwill in the business. So we look at the first stage. Acquirer. Acquirer actually is the person who acquires or takes over a particular business over a given period of time. Now, who is acquirer? What do you mean by acquirer? So the determination of the acquirer is based on the following factors. So what determines the acquirer? Number one, who pays cash or other assets are as part of the acquisition transaction. So anybody who is mandated to pay cash or any other assets as part of the acquisition transaction is what we call acquisition or acquirer. Number two, who has moved voting rights in the combined entity following the acquisition. So any person, anybody who has the right to actually vote during the combination of business. Then number three, who holds a largest minority voting interest in the combined entities. Now, when you talk about combined entities, we are looking at businesses, we are looking at companies which are joining hands together for the success of their businesses. Now, you've heard about mergers, you've heard about acquisition. These all are business combination models. So, when you talk about business combination, it is number one thing to understand this. Step number one, identify the acquirer. So, the acquirer can be identified by he who pays cash or assets. Number two, has the voting rights. Then number three, has the largest minority voting interest. Then number four, who is able to elect, appoint, or remove members from the governing body of the combined entity. So the acquirer is a person who can elect, who can appoint, or who can remove a member from the governing bodies of the combined entity. Then who takes lead in managing the combined entity? That is an acquirer. So acquirer is somebody who has full control of the operation of the acquisition processes. The next one, who is larger in terms of assets, revenues, earnings, or some other measures. So anybody who has larger share in the running of the company is called an acquirer. So in time of acquiring another business, the acquirers are people who have much muscles in terms of financial standing. Then who initiates the acquisition? Now that person who comes in with the idea of acquiring a particular company or business is now what we call acquirer. So acquirer is that person who has been given mandate to officiate, to control, to overlook, to oversee the operation of business combination. So that's step number one. So we have looked at who becomes an acquirer. Number two, acquisition dates. The acquisition date is the date on which the acquirer obtains control of the acquiree, and the measurement date for recording the assets acquired and liabilities assumed in the transaction. So we are saying when you talk about acquisition date, it is that very date whereby the acquirer is given complete control over the acquiree's assets and liabilities. So the date which all assets and liabilities of particular business or company is transferred into the new acquirer is what we call acquisition date. That date is very important. The acquirer takes control of the assets from the acquiree on the following basis. So how is the acquirer taking over control? Number one, transferring cash or other assets. So cash and other assets are normally transferred to the account or to the business of the acquirer. That is number one thing, taking control. Number two, incurring liabilities. When actually he spends, when he pays for the liability of the business which is being acquired, or he pays for the liability of the acquiree, then we say the control is taken over by the acquirer. Number three, issuing equity interest. So that is very important thing that you need to know. This is the period whereby we establish the equity interest of the business, performing the combination of this or of the business, performing the combination of the business. Number three, recognition and measurement. So we come to number three, which is another critical step. After one, identifying the acquirer. Number two, after identifying the acquisition dates. Then number 3, recognition and measurement. The acquisition method is recognized and measure the assets acquired, liabilities assumed, and any other non-controlling assets. So in the acquisition method, we need to establish, number 1, the assets acquired, number 2, liabilities assumed, and then number 3, any non-controlling assets in the business. Examples of assets and liabilities that might be transferred in the business combination. So can we look at the assets and liabilities which are supposed to be transferred in the event of acquisition? Number 1, these are the assets and liabilities which are normally involved in the transfer. We have cash and cash equivalent, we have account receivable, we have derivative assets, we have indemnification assets, intangible assets, inventory, investment, lease receivable, loan receivable, property, plant and equipment, right? Now, when you come to liabilities, we have account payable, accrual liabilities, asset retirement obligation, debts, derivative liability, environment obligation, income tax payable, lease obligation liabilities for commitment or contingencies, liabilities for employee benefits, and then liabilities for share-based payment award. So these are the assets which or liabilities which are normally involved in the event of acquisition. Then finally, exception. However, there are some exceptions for fair value measurement rule. Number 1, contingent liabilities. That is according to International Accounting Standard 37. Income tax. That is according to International Accounting Standard 12. And then employee benefits. International Accounting Standard 19. And then indemnification assets. Which assets are these? Acquired rights, share-based payment transaction. That is according to International Financial Reporting Standard, that is true. Then assets held for sale. That is according to International Financial Reporting Standard 5. So these are the items which must be on the basis of exemption, which are normally exempted from the operation of business. Just a minute. Um, there is a problem.